Warren Buffett is arguably the greatest investor of all time. Throughout his career, he became so well known for making good investments that he was given the nickname the Oracle of Omaha. Buffett announced that he is retiring at the end of 2025. However, he has still been giving some very interesting advice recently to investors. I'm going to break down his latest investing advice today, and it involves real estate. You absolutely need to hear this. Without further ado, let's dive in. Warren Buffett's past versus present views on real estate. In 2012, Warren Buffett said that buying a home with a 30-year mortgage is a terrific deal as long as we were planning to stay in the house for at least 5 or 10 years. In that year, he also said, if I had a way of buying a couple of 100,000 single-family homes and had a way of managing them, I would load up on them and I would take mortgages out at very, very low rates. So, Warren Buffett had a more favorable view on real estate investing in the past. However, he recently shared some difficult opinions about real estate investing. In 2025, Warren Buffett expressed a preference for stocks over real estate, emphasizing the greater opportunities in the U.S. stock market. At the Berkshire Hathaway annual shareholder meeting on May 3, 2025, Buffett responded to a question about why he isn't buying more property. He said there was significantly more opportunity in the stock market than in the real estate market. He also highlighted the complexity and sluggishness of real estate deals by saying that real estate requires so much more effort in terms of negotiating deals, spending time on the investments, possibly sharing ownership with other parties, and more. He contrasted this with the ease and speed of the stock market, where billions can be invested anonymously in minutes. Is Warren Buffett right about stocks being better investments than real estate? Luckily, there are historical charts that we can look at to track the performance of stocks versus real estate. For example, CNBC recently published a fascinating chart examining the performance of stocks versus real estate since the year of 1988. This chart compares the price increase in real estate, the S&P 500, and the S&P 500 with dividends reinvested over the last 37 years. In this chart, the red line is the Case-Shiller index that tracks average home prices in the United States. The green line is the S&P 500, and the blue line is the S&P 500 with dividends reinvested. So, as you guys can see, stocks dramatically outperformed real estate in this chart. Real estate prices rose by roughly 374% during this time. The S&P 500 increased by 2,218%, and the S&P 500 with returns reinvested generated 5,006%. These results are pretty clear. Stocks beat real estate over the long term, but to help you understand the implication of this chart, let's take a look at how much money you would have made if you invested $10,000 into each of these options in 1988. First is real estate. If you invested $10,000 into real estate in 1988, your investment would currently be worth about $47,400 today. Second is the S&P 500. If you invested $10,000 into the S&P 500 in 1988, your investments would be worth $231,800 today. And finally, third is the S&P 500 with dividends reinvested. If you invested $10,000 into the S&P 500 in 1988 and reinvested all of your dividends the entire time, your investment would be worth $510,600 today. So, as you can see, there is a lot of truth to the fact that stock market investments can make for better investments than real estate investments, and that they are also significantly easier to make. However, with that being said, real estate investing does have a certain key advantages over stock investments, and these advantages need to be considered as well. Here are some of the key advantages of real estate investing over stock market investing. Number 1, tangible asset with intrinsic value. Real estate offers a physical asset like land or buildings, providing inherent value and security. Unlike stocks, which can go down and drop all the way to zero, real estate retains worth due to its utility. Stocks rely on market sentiment, which can be volatile, as seen in 2022's S&P 500 declines. So in other words, because real estate is tied to a physical asset that people need to survive, it can be viewed as being more reliable as an investment. Number 2, leverage opportunities. Crucially, real estate also allows leverage through mortgages, amplifying returns with minimal upfront capital. In fact, with a mortgage loan, you commonly only have to put 20% or sometimes even less. This means you can access debt equivalent to 4 times your initial down payment. So for example, you put $100,000 down, you can buy a $500,000 property. The bank will give you the remaining $400,000 through debt. Yes, you can access leverage with stock investments too through margin loans, but usually you cannot get anywhere near the same amount of leverage that you can with real estate. With a margin loan, your broker may allow you to finance 50% of your investment through debt. So, for example, example, if you want to make a $100,000 investment into stocks using a margin loan, you would have to put $50,000 in cash, then your broker would put up the remaining $50K. This debt leverage is not as powerful as it is with real estate investments. Margin loans are also subject to margin calls if the value of the securities drops too low. A margin call is an order from your broker for you to deposit additional funds or securities into your margin account when the account's value falls below the required minimum, known as the maintenance margin. So for example, let's say you borrow $5,000 from your broker to buy $10,000 worth of stocks, putting in $5,000 of your own money. After 2 months, the value of the stocks drops to $7,000. This reduces your equity to $2,000. This is because the current investment value of $7,000 minus the $5,000 margin loan equals $2,000. Make sense? So if $2,000 is beneath the broker's minimum maintenance margin, say that 3 times fast, the broker could issue a margin call demanding you deposit more money to restore the required equity. If you don't, they may sell your stocks at a loss. Margin calls are a major risk in volatile stock markets, which is why many stock investors avoid using margin loans altogether. Mortgages do not have margin calls due to the stability nature of real estate investments. This can be highly desirable for investors who are looking to maximize their use of leverage. And number 3, cash flow from rental income. Real estate generates passive rental income, and this cash flow often outpaces stock dividends. For example, a $100,000 property with a 5% yield produces $5,000 yearly. However, the average dividend yield of the S&P 500 can be less than 2% or less than $2,000 on a $100,000 investment. Rents can also rise with inflation, enhancing cash flow even further over time. Stock dividends are less reliable. Sometimes they're even eliminated during economic downturns, such as the 2008 crash. Also, keep in mind that Case-Shiller's 374% growth since 1988 excludes rental income, which boosts returns. It only factors in price appreciation. So if you added in rental income into the equation, the returns for real estate investors between 1988 and 2025 would be much higher, more like 816% instead of the 374%. Stable cash flow is a powerful advantage of real estate investing over stock investing, making this real estate as an ideal asset class for investors seeking stability and security. And number 4, tax advantages. In addition to the other benefits I mentioned, real estate investing also offers significantly more tax benefits than stock investing does. Everyone knows this. For example, as a real estate investor, you can get deductions for many different expenses, such as your mortgage interest, your property taxes, your depreciation, the advertising, the renovations, and a lot more. All of these tax deductions can reduce your taxable income substantially. A $100,000 rental property's depreciation can save thousands annually. Plus, capital gains taxes can be deferred indefinitely with real estate strategies such as the 1031 exchange. A 1031 exchange is when a real estate investor sells one property and uses the proceeds to buy a like-kind property within 180 days. When 1031 exchanges are done correctly, the real estate investor can defer capital gains taxes owed on the sale of the first property. Some real estate investors likely defer capital gains taxes until they die. They call this the swap until you drop method. Stocks lack these tax deferral benefits. With dividends and stock gains, you're taxed directly. However, you only owe capital gains taxes on your stocks when you sell them and turn the unrealized gains into realized gains. You will then owe either short-term or long-term capital gains taxes on the assets, depending on whether or not you held them for less than a year or more than a year. How about offsetting your active income? Another absolutely critical tax benefit of real estate investing is the ability to use your rental losses to offset your actively earned W-2 or 1099 income. You see, if you implement the right strategies, you can take losses from your rental business and use them to offset your other forms of income. So for example, let's say you make $300,000 a year from a W-2 job. There are strategies that you can use to offset your entire rental income, but also a large chunk of your $300,000 W-2 salary as well. If you implement the strategies correctly, you can offset up to $150,000 to $300,000 in W-2 income. The two strategies that we use at my firm to help our clients do this is the real estate professional status, or REPS, and the short-term rental rule. With REPS, individuals who spend at least 750 hours annually on real estate activities and who spend more than half their working time dedicated to those endeavors can classify their rental losses as non-passive. With the short-term rental rule, rental properties with an average guest stays of 7 days or less qualify as non-passive activities, allowing losses to offset active income as long as you materially participate. This is particularly advantageous for investors managing vacation rentals or Airbnb properties, as these often meet the STR criteria due to their short-term nature. Unlike real estate professional status, the short-term rental rule doesn't demand a minimum number of hours worked, but it does require material participation, such as performing management tasks or arranging services. Normally, we always recommend our clients to get to 100 hours. Now, this flexibility makes the STR rule accessible to investors with full-time jobs who can strategically structure their rental operations to maximize tax benefits. Reps is ideal for those who are deeply involved in real estate, such as property management, developers, or real estate agents who can commit significant time to their real estate ventures. In contrast, the short-term rental rule is ideal for investors with less time to spare, leveraging the operational nature of short-term rentals to unlock tax advantages. By reducing taxable income, these approaches can improve cash flow and accelerate wealth building. To learn more about reps, watch this video right here. To learn more about short-term rentals, watch this video right here. Karlton, what's the bottom line for stocks versus real estate? The bottom line is for people who are looking to make as much money as possible while putting in the least amount of effort possible, then it can make much more sense to invest in the S&P 500 and reinvest the dividends. However, for people who are looking to generate the most powerful tax savings, then real estate investing can make a lot more sense. Most of the clients who come to my firm are already making at least multiple 6 figures or 7 figures. Thus, they have more of a tax problem than an income problem. Real estate investing is extremely helpful for helping these people reduce their tax bills. And in fact, we help the majority of our clients reduce their tax bills by 50 to 80% using real estate and other related strategies. Remember, for most people, taxes are their single largest lifelong expense. So building generational wealth is not just about generating profits. It's also about tax mitigation. Both of these are necessary. So please don't sleep on real estate investing as a tax reduction strategy. But with that being said, I like to think about it like this. Why not get the best of both worlds? Stock investments are great. Real estate investments are great. It doesn't hurt to have both. I have both. I think you should too. I want to say thank you for making it to the end of this video. I hope it was helpful, and thank you for watching as always. Don't forget to like, don't forget to comment, and don't forget to subscribe to the channel if you're new here. I look forward to seeing you on the next video. Cheers.